Hello, this is Linda Keith, and I am following up on a webinar, 60-minute webinar on global cash flow of tax returns when you have multiple pass-through entities in the mix. Then there's family living expenses. So those of you who are using a debt coverage ratio approach on your global, somewhere along the way have to subtract family living expenses. Now, we did chat about that on the webinar, so perhaps this question was answered later. My recommendation for family living expenses is that you do have a guideline, that you have some flexibility because you know some of your borrowers are much more frugal than others. Frequently, it's X dollars based on your geographic location, plus some amount per dependent sometimes. And then often lenders will look at the Schedule A or the various debts to try to get a feel for whether this is a person who has really expensive hobbies or really fun toys like boats and motorcycles and go skiing a lot or whatever things might be increasing the family living expenses. For my ag lenders, they often will look at whether they live on the farm or off the farm, because often on the farm they actually have fewer living expenses because so much of it's sort of intermingled, appropriately so, with the farming activity. All right. So rule of thumb, there's not actually a rule of thumb. I've seen 40,000, I've seen 65,000, I've seen 36,000. It seems to be in that 30 to 60 range. I've also seen people use a percentage of income. And my only problem with that, and it's really a problem with all these, they're just all guesses. I also have a fairly wide following of people who say, well, I figure out what it would need to be to make the loan work as my first step, and then I see if that makes sense. So I'm not actually sure that's a bad idea, especially if you're going all the way to earn net worth calculations in ag lending, to say, okay, if I've done all this right, then their family living ought to be about this. Does that seem reasonable? So you bring a reasonableness factor into play.